The most dangerous sentence in portfolio management is this one: 40% of your money is safe. I have heard versions of that sentence for decades, and most of the time it is spoken by people who confuse calm looking numbers with real protection. They point to bonds. They point to fixed income. They point to models that were built in older weather and then repeated until they became liturgy. They tell you that if a large enough slice of your portfolio sits in something called safe, then you are protected. Protected from what? That is the question almost nobody asks. Protected from price swings. Sometimes protected from panic, only if you understand what you own. Protected from inflation. Not necessarily protected from loss of purchasing power. Absolutely not. And that is where the whole illusion begins to crack. Most investors do not lose because they picked the wrong headline stock. They lose because they built a portfolio for one kind of weather and then acted surprised when the storm arrived wearing a different coat. They were taught to think in product categories instead of in threats. Stocks here, bonds there, a little this, a little that, a pie chart that looks civilized, a risk score that feels adult, a sentence from an advisor that sounds reassuring enough to help you sleep. That is not strategic investing. That is interior decoration. If you want to last in the markets, you need something stronger than decoration. You need a fortress. That is how I want you to think about your portfolio from this moment forward. Not as a collection of tickers, not as a hobby, not as a thing you check 10 times a day on a glowing rectangle because movement gives you the illusion of control. A real portfolio is a fortress. It has to hold in growth, in inflation, in currency debasement, in fear, in boredom, in political theater, in bull markets, in ugly resets, and in the endless psychological war between your future and your impulses. The source document is built around a brutally simple idea. It argues that you do not need dozens of holdings or some heroic stock, picking IQ to build a strong paper asset portfolio. It rejects the classic 60/40ths model, especially the heavy dependence on fixed income, and instead proposes a simple four-part structure: 50% SP 500, 10% international stocks, 20% gold, and 20% in an opportunity bucket. It also makes clear that this framework is meant to be applied across your paper investments as a whole, including retirement and taxable accounts, not mixed up with your primary residence, rental real estate, physical metals, 529 plans, or HSAs. That is the architecture I want to rebuild in Buffett language. Not because I think you should imitate me, because I want you to understand the hidden logic better than the people who are trying to sell you the old story. The old story says safety lives in fixed income. The real story is harsher. Nominal safety can be a purchasing power trap. The source says this directly. It points out that when people recommend bonds, especially Treasury, heavy bond exposure, they are often treating the interest stream as risk. Free, but if your interest rate is 3 or 4% before tax, while the true inflation rate is eating faster than that, your safe allocation is not actually preserving your buying power. That is exactly right. A fortress is not judged by whether the paint stays smooth during a parade. It is judged by whether it holds during siege. And inflation is siege. It is a silent siege, which is why so many educated people underestimate it. A stock that falls 20% scares them because the bruise is visible. Cash and bonds that quietly lose purchasing power every year do not trigger the same fear because the damage is spread thin and dressed up as normalcy. But if your safe wall is dissolving while you stare at its clean surface, then you did not build safety. You built a fa-fayad. This is why I reject the childish habit of asking which asset class feels least dramatic. That is not the right question. The right question is whether the thing preserves real strength in the environment you are actually living in. And the environment you are living in is not neutral. It is shaped by money printing, policy rescue, periodic inflation, political incentives, central bank intervention, and a financial culture built to keep your assets inside systems that profit from your obedience. The source goes right at that point too. It argues that conventional portfolios are designed around financial assets and the needs of the system not necessarily around real protection for you. In that framework, bonds are praised and gold is largely ignored because gold does not fit the usual Wall Street profit narrative. Of course it does not. Gold is rude to a system built on paper promises. It does not flatter policymakers. It does not flatter the comforting fiction that every unit labeled safe is actually preserving you. It just sits there and refuses to pretend. That is why it belongs in the fortress. Now let me take you through the structure itself, but not as a list. Lists make people passive. They memorize the percentages and miss the machine underneath. I want you to see what each wall is doing, why it is there, and what kind of weakness it is designed to stop. The center of the fortress is your productive engine, half your paper portfolio. According to the source, belongs in the S&P 500 through a low-cost index fund, or ETF. The document treats this as the foundation because you do not need to guess which single companies will dominate. The index does the replacement work for you. Weaker firms fade out. Stronger firms enter or expand. You capture the long-term force of productive enterprise without needing to play hero. That is the central keep. It is where your growth lives. This is the wall. Most people should stop trying to outsmart. I have watched too many individuals burn years trying to prove that they are stock pickers when what they really are is emotionally volatile gamblers with a search bar. They call it research. Often it is just ego and reading glasses. A broad U.S. index is not exciting enough for people who need to feel brilliant. That is why it works. It captures a simple truth. In a long enough fiat system, productive claims on business tend to outrun idle currency. Not in a straight line. Not without pain. Not without crashes. Not without human stupidity showing up at the worst possible moments. But over long stretches, ownership of productive enterprise is one of the cleanest engines ordinary investors can access. The source makes a related point in its own way. It says markets are designed to go up over time in nominal terms because the system itself keeps generating more devalued dollars. And when crises come, authorities tend to intervene, print, and push the system back toward expansion. The document uses housing, cars, stocks, and other assets to hammer this logic home. I would phrase it a bit more carefully, but the core judgment is sound. In a world of persistent currency debasement and recurring intervention, ownership of productive and repricing assets matters more than reverence for idle paper claims. So your first wall is not there to eliminate volatility. It is there to harness the system's long-term drift. You need that, but you do not need only that. Because a fortress built around one nation alone is still a fortress with one map. The second wall is your international flank. The source allocates 10% to international stocks through a broad fund that includes developed and emerging markets. It says most investors ignore this, but concentrating 100% of your money in one country, even the United States, is still a risk. International exposure adds diversification across economies, sectors, and currencies. That is the outer wall. It is not there because foreign markets are automatically better. It is there because monoculture is fragile. A lot of investors speak as though patriotism and portfolio design are supposed to be the same conversation. They are not. I can admire the power of American enterprise and still understand that depending entirely on one political system, one currency zone, one valuation regime, one regulatory atmosphere, and one domestic cycle, is a form of concentration risk. This is one of the easiest traps in modern investing home. Country comfort, it feels safe because it is familiar. Familiar is not the same thing as diversified. Developed markets and emerging markets behave differently, different demographics, different currencies, different policy cycles, different commodity exposures, different volatility patterns. You are not chasing some fantasy of perfect international outperformance. You are widening the map that matters because the first duty of the fortress is not to predict one exact future. It is to survive multiple plausible futures. Now we arrive at the wall that makes conventional allocators nervous because it does not fit neatly into their paper hierarchy. Gold, the source, puts 20% of the portfolio there and describes it exactly the way it should be described. Not as a growth engine. As insurance, it says gold benefits when currencies weaken. It notes that If you buy a gold coin and hold it, 5 years later you still have one gold coin, but the coin usually costs more dollars because the dollars have been diluted. It is not that the coin went to work for you, it is that the unit pricing, the coin got weaker. That is the fireproof wall. Gold is the part of the fortress that does not trust paper promises simply because they are written cleanly. It is the wall that says one government can print more currency, one central bank can debase one unit, one policy regime can rescue one market with more nominal fuel, but no committee can print ounces into existence. People who do not understand gold usually make one of two mistakes. They worship it like religion, or they dismiss it because it does not compound like a business. Both reactions are childish. Gold is not your engine. It is not supposed to be. It is your monetary shock absorber. Its job is to resist the slow vandalism of currency debasement and the fast panic that shows up when trust in paper claims starts wobbling. You do not ask a fireproof wall why it does not produce rent. You ask whether it still stands when the heat gets serious. That is how you should think about gold. And then we come to the final wall, which is the one that tells me whether an investor is an adult or just a collector of mainstream slogans, the opportunity bucket. The source puts 20% here and is very explicit that this slice can be personalized. It mentions examples like silver, copper, uranium, oil and energy, technology, stocks, REITs, Bitcoin, crypto, cash, fixed income, or a combination of them, while warning against turning the whole thing into reckless speculation. The document S rule is simple and very smart. Keep your conviction plays contained to this 20% so you can take risk without risking the entire portfolio. That is the powder room. Every fortress worth respecting keeps some capital uncommitted to yesterday's view of the world. It keeps dry powder. It keeps room for asymmetry. It keeps space for intelligence, for changing conditions, for personal edge, for selective offense. This is where many investors get themselves killed. Either they refuse to personalize anything and become purely mechanical, which sounds safe but often leaves them intellectually asleep, or they turn the whole portfolio into one giant opportunity bucket and call that conviction, which usually ends in tears, excuses, and a new respect for index funds they should have had all along. The adult move is different. Contain your aggression. That is the phrase I want you to remember. Contain your aggression. Aggression can be useful. You may understand a sector. You may have a strong macro view. You may want tactical exposure to energy, uranium, digital assets, real estate, or cash if the environment favors patience. That can all be rational. But rationality ends the moment the opportunity bucket starts colonizing the entire fortress. If your opportunity bucket becomes your whole personality, you are no longer investing. You are auditioning for regret. That is why the source S20% limit is so important. It recognizes the human need to express conviction without allowing conviction to become total war against your own balance sheet. Now step back and look at what this four-wall structure is doing. Your central keep captures productive growth through broad U.S. enterprise. Your outer wall gives you non-U.S. diversification and reduces dependence on one economy. Your fireproof wall protects against currency debasement and monetary nonsense. Your powder room preserves flexibility, personalization, and asymmetric upside. That is a fortress. Not perfect, not magical, not immune to pain, just strategically balanced across multiple threats. And that last part matters because too many investors still think a portfolio should be built around one dominant forecast: rates down, rates up, recession, no recession, AI boom, energy shock, dollar strength, dollar weakness. They are always building for one movie. That is fragile thinking. The fortress is not built for one movie. It is built for multiple invasions. The source says this in simpler language near the end. It argues that this allocation does not rely on one outcome. If there is growth, stocks can perform. If there is currency debasement, gold can protect. If there are special opportunities, the opportunity bucket can capture them. That is exactly how a rational allocator should think, not what single future am I betting on, but what kinds of futures can I survive without becoming stupid. Survival without stupidity is an underrated investment goal. And that brings us to the real reason most people fail, not complexity. The source says this directly. It argues the hard part is not the structure itself, but discipline. People panic in downturns. They try to time the market. They withdraw too early. They overtrade because they are glued to their phones. That is the real battle, not the percentages, the siege inside your head. A simple fortress still collapses if the guards open the gate every time they hear noise outside the walls. That is what panic selling is. That is what performance chasing is. That is what overtrading is. That is what doom scrolling your own portfolio is. You think you are being informed. Often you are just rehearsing fear until it feels like strategy. The whole advantage of a four-part structure like this is that it gives you enough clarity to stay invested without needing to perform genius every quarter. That point matters more than most people admit. A mediocre portfolio you can actually hold is usually better than a theoretically superior portfolio. You will sabotage the moment volatility makes you doubt yourself. The source hints at this when it says the structure helps you stay invested, and that this may be the most important thing of all. That is not a side benefit, that is the hidden engine. Your returns are only as good as your ability to survive your own emotions. Most investors are not poor analysts, they are poor climate managers. They let every news cycle alter their internal weather. They think a portfolio should entertain them. They mistake motion for intelligence. They interpret simplicity as lack of sophistication because the industry trained them to equate activity with expertise. I do not. Simplicity is valuable when it makes behavior more durable. The source even says less is more, and in this context that line is exactly right. The public tends to overcomplicate investing for the same reason weak people overcomplicate fitness. Complexity lets them hide the fact that they are not doing the obvious thing consistently. It gives them a story. It postpones accountability. It lets them feel advanced while still being ineffective. Wall fortress removes that excuse. You know what each wall is for. You know what it is supposed to protect. You know where your aggression is allowed to live. You know what not to expect from each component. That last part is crucial. Do not expect the fireproof wall to outrun the engine in a hot growth year. Do not expect the outer wall to be the star every quarter. Do not expect the powder room to always look brilliant. Do not expect the central keep to never suffer a drawdown maturity. In asset allocation is mostly about assigning each piece the right job and then refusing to become disappointed when it does not do another job better. That is how adults think. Children want every asset to be the winner all the time. Adults want the fortress to survive. Now, I need to address one more thing from the source because it is central to the whole philosophy. The document argues that because of money printing, inflation, and repeated intervention, broad assets tend not to crash permanently in nominal terms. It points to homes, cars, stocks, gold, and other assets as examples of things that may swing but tend not to stay down forever in a system that continually creates more currency. Again, I would not turn that into a cartoon law. Individual assets can underperform for very long periods, and some never recover. But as a broad systemic judgment about productive assets, scarce assets, and nominal repricing inside a fiat architecture, it contains more truth than most conventional asset allocation pamphlets are willing to admit. That is why sitting permanently in nominally safe paper can be more dangerous than it looks. The system is not built to preserve idle purchasing power out of kindness. It is built to preserve itself. Your portfolio has to be built with that in mind. That is the real argument underneath the four investments, not simplicity for its own sake. Strategic realism. You are building a structure inside a world of inflation, debasement, policy rescue, volatility, and human error. So build for that world, not for a textbook, not for an advisor, risk questionnaire, not for an old rule that said bonds are safe and that was supposed to end the discussion. Now, let me make this painfully personal. If you are still chasing the perfect allocation because you are terrified of ever being wrong, you are already making the wrong kind of portfolio. The goal is not to remove uncertainty. The goal is to make uncertainty survivable. If you are still telling yourself you need to be an expert stock picker before you can invest, You are already acting under dead assumptions. If you are still allowing one position, one macro thesis, or one emotional obsession to dominate your balance sheet, you are not building a fortress. You are building a shrine to one idea if you are still overtrading, because watching the app makes you feel in control. You are not managing risk. You are feeding anxiety and calling it attention. If you are still ignoring gold because it feels old-fashioned, or ignoring international because home bias feels comfortable, or refusing an opportunity bucket because you want all your money to sit in one rigid doctrine, then you are not being disciplined. You are being inflexible. Inflexibility is one of the easiest ways to make a modern portfolio brittle. A fortress has structure, not rigidity. Those are different things. Rigidity shatters, structure absorbs. That is why this four-part design matters. It gives you growth without requiring clairvoyance, diversification without clutter, protection without paralysis, flexibility without total chaos. That is an elegant combination. And now comes the only question that matters. When the next ugly stretch arrives, and it will, what kind of investor are you going to be? The one who stares at the market all day, panic sells, and tells himself he was being prudent. The one who turns every drawdown into a referendum on his intelligence. The one who keeps shifting walls because the noise outside sounds convincing this week. Or the one who already knows what each wall is for, understands the weather, keeps the gates shut when fear is loud, and uses the powder room only where it belongs. That is the test, because a portfolio is not judged by how good it feels in euphoria. It is judged by how well it protects your judgment in stress. That is what this investment fortress is really trying to do, not make you look clever, make you hard to break. And if you can finally understand that difference, then you are already much closer to building real wealth than the person with 50 positions. 3 hot takes, 1,000 notifications, and no idea which wall is supposed to hold when the fire starts.